I'm at. I'll show you guys exactly where I'm at year to date. Hold on. Here we go. So year to date, I am down 3.28%, $35,000. And on a percentage basis, my portfolio is down 3.3%. Now, granted, a lot of that bounce back is occurring today. But understand, if you are doing better than minus 15%, the Nasdaq yesterday was down 20% at one point. If you're doing better than down 15%, what's the S&P? This is the benchmark I really use. So now S&P was down at one point more than 14%. This is year to date, by the way. Down 10.5, like down 3.4%. I'm pretty thrilled with that, all things considered. I'm down a lot of money, don't get me wrong, but on a percentage basis relative to the S&P, I'm feeling okay. Okay, guys, coming up next, we're going to bring in Chris Pulver. Him and I have been super busy in our VIP group. If you are not inside of the VIP group, or you don't have access to the Edge Finder and you'd like to take your trading to the next level, stop messing around, stop running in circles out there. I know how difficult it is to find people who will show you something like I just did. Okay. I will show you guys my portfolio all the time, up or down, rain or shine. I've lost 35 grand. I don't care. I'll show you guys. This is my channel. This is what I do. Right. Same thing with Chris Pulver. We are as transparent as it gets when it comes to trading. Chris has been doing this a lot longer than me. So stick around and learn something from him for free on this YouTube channel, or consider taking it to the next level. Get access to our tools, track institutional positioning with the Edge Finder or the put to call ratio. Start using the tools that we use, or consider joining us inside of the VIP Discord. For either one, we'll drop a link here in the chat. You can send us a direct message using that, or head over to a1trading.com and use the live chat feature in the bottom right. Chris Pulver's taken over the show. Again, a veteran trader who also shares real broker statements and all that sort of good stuff. And I hope that you take that as seriously as we do, as it helps the audience know you're not wasting your time watching somebody who doesn't have real skin in the game. With that said, stay tuned. We'll be right back with Chris Pulver just after this quick break.
Hey everybody, thanks for tuning in to today's A1 trading session. We love engaging with our audience, talking shop, taking requests, and sharing our favorite setups. It's about that time where we're going to review a bunch of indexes, stocks, currencies, gold, silver, Bitcoin, and pretty much anything else, and share our insights. If you're wondering what trades I'm in, if you're wondering what trades I'm taking, and you'd like to see exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat and you can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show. Good morning, everybody. Happy Tuesday. It certainly feels a little bit better today than it has been the last 3-4 days. Pretty wild swings yesterday. Just to put it in perspective, we had a percentage move intraday from a close Friday, a gap down of about 4.5%. So we gapped lower about 3%, pushed another 1.6%. So we had from close Friday to low Monday, 4.62%. That was kind of the extent of what this near-term pain has felt like. Then we had a rally of 8.55% intraday that then ended up settling right back into the middle, and it basically finished completely flat. Crazy kind of shakeout type day. IV was incredibly high. I took some more bites and nibbles. I added some trades into the Pulver alerts. Those trades include a trade. Excuse me one second. Let me go down to my tracker here. So includes a trade on IWM, Micron, Apple, NVIDIA, Google, SPY, Delta Airlines. TLT I'm a little kind of annoyed with. I didn't do anything other than roll my calls out, and I tried to roll them up. I still think TLT looks fairly bullish towards the 100 handle. But in this near-term equity rally, it's not a surprise we're seeing a dip in bonds and a rally in equities just as a little relief rally. And I also have some puts, SPY and Qs. This was for my margin accounts. I did some naked puts, 435 put on the SPY and a 365 put on the Qs. Right now, each one of those are up around 50% within like a week. So that was a nice thing about selling premium. It looks like this. I'll go back to SPX in just a second here, but here's the VIX. VIX was all the way up towards 60 yesterday. That was the high of the day. And then we just aggressively faded off of that. So VIX, naturally a reverting instrument. I wasn't, sure. Obviously, nobody was, like, when the VIX was going to stop. This was like the third largest spike at all time. I think this is the third largest. I can confirm that here, but give me one sec. Let's go. Pretty sure this is at least top 5 VIX, but we're talking like crazy crisis levels that we've seen in the past. But there's always something else. Like, there's always some other extreme in the market. You never know. Okay, so we are officially now the worst performance through the first 65 trading days. It is 5th all-time worst for the first 65 trading days of the year. Congratulations. If you can survive 2025, you just survived the fifth worst start in the first 65 days of trading. What else do we have here? Roughs, recessions. Oh yeah. I talked about this yesterday in class. Biggest 3-day spikes. There you go. So the biggest 3-day VIX spikes since 1990. It is 5th and 6th all time. Biggest spikes in the VIX. Impressive. One indicator that I've been mentioning for the last couple of months would be looking at your S&P above the 50-day moving average. Right here, I've taken some nibbles. That's all it is. I don't think the lows are in necessarily. I think there's still some more pain and uncertainty ahead, but a relief rally certainly feels pretty good for maybe the next couple of weeks. I think this little cycle between like March expiration and April expiration might offer a bit of a kind of corrective window. So we had like all of the interim like tariff tantrum pain priced in. That's what yesterday's wild price action was. But this to me offers up a little bit of a bargain. If you wanted to go short term long the S&P, it's a pretty good time to do it. The last time it was this low would have been the bottom in 2023 after that August-September pullback to around 8 to 10%. And before that would have been the summer and fall bottom, which was the bottom. This September bottom in 2022 was the bottom of the market. So before that, bottom in 2020, that's a COVID bottom. Bottom before that would have been Volmageddon in the end of 2018 when the Fed raised that 4th time, the market crashed, and December 2018, the Fed kicked right back in after a 20% correction, and another good time to be buying stocks. And we melted up to all-time highs all over again. So you don't see this very often. This is why I angled my portfolio at least short-term long, and seeing the benefits of that today. So I've got some trades in on SPY, QQQ, some naked puts, like I said, selling some high premium. I'm not necessarily looking to hold those all the way to expiration. Some of those expirations are out into May, out into June. But if I'm at 50, 60, 70% profit on those trades, I don't need to worry about the gamma risk towards the expiration of those options. I'm just going to take a majority of the profit, move on, and get the buying power back. So let me have a quick look. Up on the day, I mean, obviously P&L's had a huge swing. Right now we're, sharing, you show me mine, I show you yours. And, my portfolio is still red for the year, but certainly doing a lot better. So 67K-ish floating out of the total to the start. So I'm down 2.3% for the year, but I'm still sitting on, hedge profits and positions that just need time to work. Position levels that aren't necessarily threatened. It's just been a big change in volatility, and that has made option prices go wild and crazy. So Tesla back up above 248. It shows here that I'm down, 26K on Tesla, when the reality is if we stay above 247.50, I'm going to make like $8,000 on Tesla this week. So it's just option prices have to settle down. If we can stay above 247.50, I'm not going to get cute with this. I'm just going to let it get called away. I'm not going to roll it. I'll take the income trade. I sold some premium on Tesla. I still have some ratio spreads running with out into May, so those aren't threatened just quite yet. Let's go to those naked puts for a second. So here is a put on the Qs. I think I did a put on the Dow as well. Let me double check that. So Dow, I did a 1111 trade. So that's a 360 on the Dow. That's currently down about $900, but that trade, we'd have to see the Dow drop another 10% for my position to be in jeopardy. And that trade is good for a $550 winner. So is that what I did here? Buy. So I did a 112. Okay, so I'm selling. That's why. But this is only out to June. I'll keep a close eye on this, but we'd have to drop another. Yeah, we'd have to drop basically 10% on the Dow in order for this trade to be threatened. Not that it can't, but I still collected some pretty high premium in some of these recent moves to the downside. Let's go Qs. So I have a put that is up around $100 right now. A trade right here that is already up $126 just in the last 24 hours. So this trade's up 22% real quick. Going after like a 30 to 40% winner in this one. Keep an eye on those. And then SPY, my put. This is just a naked put. Is that one grouped? Hang on a second. SMH, that one's looking fine. This one is ungrouped. So this group, there we go, naked put. Okay, so this is, there we go. So it's getting these labeled. So looking at profit there, naked put for 435, already up some bucks. Naked put for 460. This one's taking on a little bit of heat, but I'm okay with it right now. I collected 423, and this is an example. Like I collected $4 and change on a 460 put. We're trading at 524. I'm 60 points clear of this. What was the low on the SPY? I don't think the low was 460. The low was around 480, right? So we'd have to revisit this low by, I guess, June, which is possible. But I'm also not, I'm not opposed to taking ownership and shares of the SPY with this account, which has $250,000. If I bought 100 shares at 460, I can allocate that and take a chunk of shares and repair it. So anyway, point is, a lot of trading going on. This will be a living, breathing P&L cycle. My goal is to get back to the yearly highs, which my yearly highs were around 205K. And that was after the March decline. So we had the March decline, had that little 2-week rally. I was at 205K right there. So now that we are dramatically lower than that, I'm hoping for a little relief rally. I'm curious to see how close I can get back to those all-time highs again and still be better positioned for, all-time highs, no problem. If we get back to all-time highs. However, I don't think that this market is just done going down. Earnings season is kicking off on Friday. It starts with the banks. So this is what the earnings calendar looks like. It's not super busy. I mean, we only have, I'd say 20, 30 notable names this week. But Delta, which has had a monster decline of about 50% since the all-time highs. And then we start out with Friday, what's going to be kind of the big guidance for Q1. JP Morgan, BlackRock, Wells Fargo, BNY, Morgan Stanley, their guidance / comments will be interesting. If they, just talk, hey, these are the numbers, earnings per shares, revenue, our consumer. I mean, I don't know. I have a feeling they're maybe going to say something tariff related, maybe talk about the current environment and uncertainty. But if they wanted to do kind of a solid for the overall market, then they should probably keep it pretty neutral, if not somewhat optimistic, if they even are. Look, I think that what the banks went through in 2008, that they are more battle tested and prepared to prevent a 2008 from happening again. Not saying that it can't in some different way. But point is, I mean, it kind of sucks to have to report earnings right now, right? After dealing with a what's almost like a systemic risk to the markets, but you see the intercorrelation, you see the connectedness, and you see the volatility, and you see how quickly the market can just go into like straight fear mode. It is irrational. I mean, you can't think your way like, oh, that made sense. I mean, the only thing that made sense this year to me, and again, this is all from a technical standpoint, is we had a correction in the 200 moving average and we paused there, and all this was a measurement. It's not that difficult to measure this move. Watch. So if you go from high to low, okay, and you measure this move to the downside, that's pretty darn good. I will do that again if you missed it. It's kind of like a magic trick. But a cup and handle pattern, which is the market drops aggressively, pauses. The way you measure that move is you box this high to low in, and then you measure that breakout move. Okay. And watch how pretty perfect that box is. Here is the high to low swing right here. Okay. And then watch the breakout point. I'm just going to copy and paste this. Boom. Copy and paste, put it right at the breakout point, and look at where the market bottomed. Right there. That is why at the, 490, 485, 480 level, I was looking out of the money, high implied volatility, selling puts, right? Doing bull put spreads. I mean, they're out of the money, but I was getting, $4, $5, $6, $7 on some of those puts for a probability that IV is not going to continue to get higher, and you could go way outside of the expected range for what is lining up to be a pretty safe trade over like a 45 to 60 day window. So the market, from a technical standpoint, did pretty darn well, despite how nasty it felt. It was destination technicals. It just happened to do it in 3 days. So it's not like this market wasn't forecasted or measured ahead of time. And if you've been following the stream for the last month or so, once we had this push down to like 550, I said this area is vulnerable. If we break below this level, there's nothing stopping it. Don't think about this level or this level. Nothing stopping this until that previous all-time high. And where do we come to? Previous all-time high. Like, even though this was a crazy, scary sell-off and we hit that 20%, peak to trough, it still was findable, right? And here we are, off those lows. Like, that's a pretty solid reaction to that, right? So anyway, I just, let's keep this like really simple, because the bigger fib level that I'm watching, we also pulled back to right around the 50% zone. So you take this previous swing here from the lows in October 2022 after that bear market low, and I'm still like, I still kind of agree this. I think there's going to be some trouble ahead here now that we have flirted with this previous high. But the nice thing is as long as this isn't like a deep recession systemic risk that brings us into open space this way, that would be like way more concerning. Okay. If the market can maintain protection around that level, this could be kind of our chop fest in here. And I think that's okay. I think we can survive in there. Just don't do anything crazy. But if this is a wave 1, 2, 3, we had our pullback for wave 4. I still wonder if it's possible that this whole thing with tariffs settle in, show some U.S. economy resiliency, as long as U.S. job numbers don't start to trend aggressively higher by September, October, November, December. And the reason that's the window I'm watching so closely on jobs is because all of the federal government layoffs are not really going to hit the tape until September or after. And if those workers don't find jobs in the private sector, that's going to start popping up in our jobless claims, initial jobless claims, continued jobless claims. And that unemployment rate goes from a 4.1 to what the Fed is forecasted by the end of the year, around 4.5%. That's a big jump. I don't think there would be any type of intervention by the Fed until maybe this spikes up into the high 4s, maybe even 5%. I don't think there's any intervention from the Fed unless we are down to maybe 4,000 and having like maybe a 30% dip from the all-time highs. So this idea of like the Fed put or the Trump put, I mean, I don't think there is a Trump put as far as if all the administration is thinking about is trying to play hardball with this tariff stuff. I don't think there's a Trump put. I mean, clearly his approval ratings have dipped hard. Narrative isn't changing. Fine, but the Fed put is still lower. The price to earnings S&P, we're at 19 right now. Usually when the market finds a true bottom, we're trading around like a 17 or 16. Unfortunately, that's a little bit lower. That's like a 4,500 S&P. That's a 4,250 S&P. And I don't know how that settles in, but we're going to find out. Okay. All right. So anyway, fib wise, we hit a 50% pullback zone, previous all-time highs in the 2021, 2022 peak. That's exactly where the market pulled back to. And you can see that measured move from the high-low breakout point, like a big bear flag. And now the market's up. And, from the lows from yesterday, it's like, that's a big swing, by the way. In 2 days, you saw bottom to move. I mean, that's an 8.7% swing in 2 days. So am I super stoked and excited about the market showing, 3.79%? It's certainly better than being red. But I think this is a relief rally, and the bears are still going to have their chance to claw back a little bit. Where would I be watching? It's here. Anywhere at this gap fill or anywhere at this past support becoming resistance, or even the 200 moving average. Any relief rally that gets us up into this area, I'm going to look for some shorts or some shorts or some shorts. Those obviously aren't perfect, but trading options, I can probably give myself like a 30, 60, 90-day window to have some of those shorts reposition with much lower volatility, so that the puts will be a little bit cheaper, which is good, because even down here, buying an out-of-the-money put was pretty expensive. And granted, the market was gapping lower, and those paid pretty well. But I was still paying somewhere into $4, $5, $6 for a long put. That was out of the money, by the way. Okay. Out of curiosity, you just copy and paste it, calling the bottom. I mean, yeah, it's just a breakout move. I mean, it's essentially like a cup and handle, but just inverse. So a cup and handle. I actually know that is the cup and handle pattern. The inverse cup and handle would be bullish move, and then a pause, and then a rip higher. Right. So I mean, what's wouldn't be surprising is if we have this rip here, and then we pause, and we have a inverse cup and handle that does the exact same thing. And maybe this comes right back to the 200 moving average. And the bulls are, feeling better. The bears maybe come back in for a swing, but we might protect this low. And this market might not break highs, not break lows, and we just kind of grind through this 20%, peak to trough that we're gonna have to trade in between. I think for the market to get to all-time highs, we've got to justify a lot better fundamental data. We've got to see that companies are resilient with earnings. We're going to have to see that the Fed is going to stay on pace for cutting rates this year. I think that will help the Russell more than anything, which is clearly in a bear market at 20+%, even though the Russell's ripping up higher today. So anyway, cup and handle is what I'm looking at. You can search the patterns, you can see how they're measured, but it's pretty straightforward. You have a high to low, and then a little pause. Okay, and I call this more of a cup and handle versus a flag, because usually flags aren't monster patterns, but a high-low pullback like this, okay, that type of pullback, just measure the move. Well, I can just draw it out here. So you measure this move here, make that a little bit thicker. You measure that move from the high-low swing, and you can just measure the breakout point. And that's usually about where the market, finishes the move. It's technically fulfilled, and there's usually a bounce. So yeah, just good old technicals. All right, that's SPX. Let's go to some other top down. So everything's looking green today. That's super encouraging. I'll continue to watch, for the day. I've got some expirations to comb through here. So I have a couple of trades running this morning for 0 DTE. I closed out a couple already, have some profits. This one is 40 by 25. That's a ungroup. Another bull put by the end of the day. So that one for 65 cents. That one for 90 cents. Hopefully those continue to run for some more profit on the day. I'm probably going to take a loss on XSP. That was I took some nice chunks of profit on like 16 winners on XSP, but I'm going to take a couple losses, and those are going to stack up, which will suck. Maybe, but it's by this. I've got one that's going to be a small loss by Friday, and then I've got other ones out into late April and also May. We'll see how those play out. Tesla, like I said, staying above 247.50 this week. I will. Like I'm saying, I'm showing 26K down because the volatility has been so big on Tesla, but I get it called away this week for like an $8,000 winner. So if it stays above 247.50, that's profit and a bunch of buying power back. Nasdaq, some puts, some combos. Damn it, man! I'd like close out my effing shares. I put this trade in yesterday to let me hang on a second. Qs. I closed out my long puts and it just didn't fill. Like, what the fudge? This one closed out. This one closed out. Okay, let me try this again. So I was assigned, it was a weird assignment that I had. This position is fine. This one, no shares. Yeah, this is fine. So I've got a 490 by 430 still running. That's a bull call spread still running. Let me separate this one. Okay, and then a put. So I'll be watching that one. It looks like a couple of these didn't close out for my. So this one didn't close out. I still have it pending. What the fudge, dude? So I was assigned at 5:30. I've got a put on for 5:35. I'm trying to close both of these out at 5:35. I actually wonder right now if I close this thing out, I'm still taking on a small loss there. Signed at 5:30. I mean, it's trading at 534.99. Like, I think if I go unfavorable, let me see if I go 98, 97. Hmm. Yeah, I mean, I need to close this out at my long put level in order to give me my. I just don't want to tie up the buying power. So I suppose I could eat like the extra $50 loss if I just close it out right now. Let me see here. Let me see if I can get this for 534.90. Yep, so it says unfavorable. That's what I thought. That's what I was doing before. So let me take like 5 cents more. All right, I just gotta let that one marinate. I'm gonna modify this and just take on just a little bit smaller. It shouldn't be this way. I should be able to close this thing out for like 534.99. I'll take the 5 cent hit. That's fine, but I shouldn't have to take this much like width in my bid mid ask. So I'm gonna go 534.95. Okay, this one's fine. This one's fine. This one's fine. This one's fine. This one too. So 534.95. All right, I'll let those go. Those should get filled today. Should be able to get some buying power back. Same thing here. Okay, watching those. That might be the last one. Q's just partial. Bull call. Bull call. All right. All right, we'll go top down. I just want to get through a couple of those things. Oops, not a close. There we go. So they're just getting filled now, getting the buying power back. Beautiful. All right, that's good. All right. Dollar index still pulling back. We also saw some flash crashes in the currency world. So big spikes on Swiss, big spikes on Japanese yen, big spikes on dollar. Currency strength chart not working for some reason. There we go. And I don't have any screenshots from the last couple of days, but basically when we started to see super high volatility, it was stronger Swiss, stronger Japanese yen. The dollar was beat up really badly and then pivoted harder on that one-on-one handle. Right now, things are a little bit quieter for the day, but it's a risk-on day. So Aussie, New Zealand making a big comeback. I got filled on a 60-20 buy trade on the Aussie dollar. That was a pending order from a while back. I'm going to ride that one out a little bit longer. I'm still long on the Swiss. I just lowered my cost basis because I had some scale in levels. I'm still just sitting on some positive swap for the most part between the accounts I'm trading. I've still collected a solid like 3 to 4% on currencies. It's just now it's okay. Well, my break even is a little bit worse, but I'm slowly working costs lower. I just have to be patient, and I'll still be patient. But eventually, I'll be working through those Swiss pairs. It'll be fine. So here's today. I mean, decent amount of volatility. New Zealand, Aussie on top, dollar weaker. Things kind of hanging out at baseline. No real outliers outside the Aussie, New Zealand. Take a look at oil. I had a good conversation yesterday. I think $60. Be careful of shorting oil because below $60, things get a little nasty. Where basically below $60, most producers, it's unprofitable. It's mostly unprofitable. If we're below $60 a barrel right now, it's unprofitable to be producing oil. The U.S. can get away with it, but they don't love margins. I mean, I'm pretty sure the U.S. right now could probably produce oil if needed in like the mid 30s. Saudi Arabia, same thing, mid 30s. And that was kind of this big push is trying to get oil prices down in order to maintain market share, but it's not super profitable. It would just basically squeeze the producers that can't be profitable. And, that's why we have wars. So anyway, I think this, initial break, it could be an overreaction, maybe. But I'm just trying to stay out. I mean, this is the type of silly move that busted up a lot of traders. I know a lot of good traders that unfortunately they sell a bunch of premium, but they do it both ways. And a big kind of, 2-3 standard deviation move like that will just bust up those trades. And that is why I continue to preach, just trade like risk defined. I like if you want to do a strangle and if you wanted to sell a call and buy a call sell a call, sell a put, that's fine. But a 2 to 3 standard deviation move will completely F up your trade. So I would rather do a smaller credit, define risk, and take the same trade, but never let a outlier type move make this worse than what it already is initially. So I think smaller trade, smaller risk is better. Natural gas, we are retreating, but I'm still long in this through 2027. So I'm probably just going to roll my calls down or roll them out. I'm in for this all like break evens around 16.25. I wouldn't mind looking at like a 20 for income. Maybe a 20 or 21 if I go at another 30 to 40 days. Let me see what that UNG is trading for right now. So UNG, I've got 91.4% of that covered call or that sell call in profit already. I could just roll it. I mean, it's worth an extra 6 cents for the next 9 days, or I can just roll it and start this process over. So I'll probably end up rolling that. Uber had a big swing. I've got it's a 1-1-2 trade. So I bought a put, sold 2 puts. So it's a bear put spread for $2.50 and then 2 puts at $60. That one is out to May. I'm just going to hang in there. That's I think that's through earnings or before earnings. Let me double check on Uber. Uber earnings will be April 30th. So I'll have to take that trade through earnings. All right, let's go back to oil. Gold. I'm sure there's some traders that bought the dip on gold. I know a lot of people are liking okay, my 50 period moving average 29.50. Okay, that's fine. I still am not ready for gold to be long unless I hopefully see a deeper pullback. So I mean, again, and call me picky, right? But if gold wants to keep going higher and higher and higher, that's fine. I'm still running with shares of GLD. That's fine. If we have this period offering some consolidation, maybe the bulls just take a freaking breather here and this stretch away move, like we had a correction here when it got stretched away pretty far. We had a correction here when it got stretched away pretty far. I could see gold, not just returning to all-time highs, but rather facing some form of consolidation, letting some of these moving averages catch up a little bit, right? And then any move like this that offers a dip at the 200, sure. I'd like to, I just want to see that 200 offer dynamic support. It's been 380 bars. And I think that is a valid bar count plus the stretch away move of nearly 20%. This is why I'm not crazy bullish right now. It's like, I'm just going to hold positions. We stay further and further away from it. That's fine. But to me, I'm a lot more excited about balancing this buy zone and trying to buy some dips that are, hopefully pretty meaningful. That would be this previous high right here. That would be this 144 to 200 moving average. So if we find those, I'm a lot happier as a buyer. If we consolidate, that's okay, but not great. I'm just consolidation. I'm just going to hang on there and hold. Okay. Silver's making a nice little comeback. Still a long ways off. I mean, silver's performance was crap compared to gold. Silver was down 18% in 3-4 days of trading. And right here, 6.5. Wow, that's so different. Gold was down 6.5%, while silver was down 18% from high to low. That's not even close, and that makes me think that this XAU XAG chart has broken to the upside. Wow, by a lot. Not even close. So, massive breakout. What was a pretty solid range between gold and silver. Now gold is just getting the huge bid. So again, that could quickly change. I mean, we could see this come back in. Maybe this new range establishes itself. I don't mind either one, but gold is clearly getting the nod as like a little bit more safe haven, a little bit more store value, a little bit more of an asset investment versus silver is like poor man's gold. And this whole idea of like global slowdown, look no further than copper. Okay, copper, not there yet, but copper is. Thanks for grabbing that question, Nick. Yeah, I was gonna say, I mean, I don't make any money on YouTube. I mean, I have like my personal channel is like 9,000 subscribers. I, make nothing on YouTube. I don't do it for money. It's like YouTube is I quickly realized that YouTube for me in my start is like, it's more of a creative outlet. It's more of a passion project, more of a, hey, it's trust content. And if you want to, trade with me live, then I've got services and other things that I run, similar to what, it's like Edge Finder and Pulver alerts and things like that. It's like I trade. So there's my income source. Copper, we're at 4.20. And this really sucks, but in the next 16 days, I'd like to see if copper can stay above this level. Now, I do have a profit trap here between the four. I did a 111, so I do have defined risk on this one. I'm hoping that we stay above, right? I hope we stay above, but if we stay above 4.18, 4.18 on copper is kind of perfect because that would be an extra profit trap. So if I go into my copper trade here, there it is. So copper here, 1111. So here's the trade. If I can zoom in, let me. All right, it's not the greatest zoom in, but you get the idea. So we're trading around 4.21 right now. I do have a profit trap, so even if we go up on copper, that's good for the next like 16 days. If we continue to go down on copper, it's okay because I actually have a slightly bigger profit trap there. So this is 175. I mean, why am I not showing the profit trap here? There's got to be like an extra $100 or so. Okay, max loss is 1,500. Max profit should be 275 versus whatever. I'll figure it out. If we go up, it's fine. I'll still make the 160 on the trade. I got a little profit trap there of should be $1, but I'll keep an eye on that little profit trap. All right, back to silver. Bitcoin, we're at 78K. Again, key level on Bitcoin is 75. We shouldn't do too much damage below that. As long as we're not really doing any aggressive closes below 70,000, I think Bitcoin is still pretty good. I know a lot of Bitcoin enthusiasts were all excited that, Bitcoin is decoupling from the S&P. Maybe. Is it though? I don't know. Because the S&P is up 4% today and Bitcoin's down. So, I don't know. I mean, I still think there's just this whole window. It's like you've got BlackRock is probably the biggest resiliency in Bitcoin to me since it's been securitized, and you've got IBIT and all your approved ETFs. Price action is definitely a little bit quieter, not nearly as volatile, but from a technical standpoint, this resistance is going to be key, right? If this resistance holds and offers support, that is good. If we stay above this 74, 75K mark and start getting on the right-hand side of the trend line, that would be an encouraging sign for Bitcoin and some risk on to happen. But like I said, conversations were swirling over the weekend of, it's decoupled and this is how it all changes and the whole market's interconnected, but Bitcoin's not. I don't really believe that. I think that basically it's like everyone holds Bitcoin, right? And so that's what it shows me, is that now that there's allocations in and people are holding Bitcoin, they're just not selling. So it's not panic selling. Maybe it's more of the allocation of Bitcoin. So if you have a 1% allocation, you don't need to sell your Bitcoin. Ride your 1% out, right? So I just wonder if like the I don't know, the shitcoin crowd is gone. The pump and dump crowd is gone. The bull market geniuses are gone. Like the market we just experienced the last 2, 3, 4 weeks will make a lot of people disappear. Like it will flush out all the leveraged, over leveraged, silly traders that only make money in bull markets, have no idea how to prepare for a downturn, and obviously don't stay solvent when it does happen. So, but I'm curious on the allocation side if this is just look, you're going to hold through it. It's a tiny allocation, you hold through it, and that might be contributing to why this has shown some resiliency, as opposed to it's this big dirty secret that nobody knows. It's like, I think it's pretty clear that BlackRock is one of the biggest asset managers in the world with like $3 or $4 trillion under management. I'm pretty sure that they have some high net worth clients and institutions that are holding some stake in their portfolio of Bitcoin, and whether it's just IBIT or it's actually trading through some exchange. But a 1% allocation is not that big of a deal. Like, look, if I ever lost 1% of my account, could I make it up? Absolutely. I'm personally a little bit more invested. I've got clients in for about 3 to 5% Bitcoin. Personally, I'm into like about a 10% window in Bitcoin for risk capital. But again, it's been nice to see it somewhat resilient. That's all. Okay, so we'll see. Just keep an eye on it. But like I said, I don't want to see it break too much lower than like 74K. $70,000 shouldn't be breaking 70,000 if we want to maintain this bull market. MicroStrategy, kind of the same thing, hanging out around that 200 moving average. We could be pretty choppy going back and forth. And here, that volatility could be like $100+ swing. I'm still looking at some income opportunities. I've got my collar trade. That's a 310 by 240, and just watching, see how it plays out. We're back down to the opening gap levels today. Let's see how price plays out for the morning. I'm just watching this right here. So we're gapped higher, up for the day, back down to flat. See if we just chop around. I'd like to see prices, if we're coming in to fill this gap at all today, I'd like to see it at least bounce back up. Maybe the bulls are a little bit hungrier than the bears today. I'm hoping that's the case. I'm hoping this recovery is not like a gap and fade. If that is the case, then we are certainly in an environment where this is not going to be a friendly bull rally in a bear market, right? Like if this market crashes back down and takes out today's gap, these bears are really aggressive. But if the market can just kind of hang out today and chill the F out for, a day, then this gap looks doable. This pullback into some, Fibonacci levels from this recent decline, we could try to find some of those corrections. I'm trading futures. Have you ever see me halt trading when futures market is 10%? It should be 7, 13, and 20. They usually go in 7% increments. 7, 13, and 20 are the circuit breakers in futures, circuit breakers on the indexes. So I think last week the Russell futures halted at 7%, and they only stop it for like I think it's 15 minutes, and then it's like it just positions build back up and they renew it, and it could be, just because they halt doesn't mean anything good is happening. So if it ever happens where the trading is halted, usually it's going to get loaded back up and resume that direction. So it just kind of gives market makers a chance to get a breather and a break, but they're probably hedging like crazy to make sure they're not going to get exposed to anything worse. But it's a 7, 13, and 20% circuit breaker usually. Okay, let's go back to this. Coinbase 163. I do have a Coinbase trade for April 17th. I need to see if it'll stay above 155. So far it is right now, and this is another one that shows I'm probably red. So portfolio wise, let's go Coinbase. So it shows that I'm down about $600. Yeah, I'm down a little bit, but this trade is out 9 days, which is next Friday. If we're above 155, I'm still making money. We're trading around 163 right now, so I've got some wiggle room. Realistically, if I did take shares of Coinbase, my break-even point would be 155 minus 5 minus 2.25. I own shares at 147. I would do a quick cover call at the money to repair that. Probably try to grab anywhere between like $5 to $10 on a covered call. So that should be an easy repair if I need to take on the ownership. I'd obviously hope it stays above 155 and gives me a nice little, winner of, about $1,000. So 155, we're watching closely. Let me set a chart alarm here. 155, that is my ratio spread. Actually, it's more of a 111 sell put there. So a little bit of wiggle room right there. I mean, this is the systemic stuff I talked about last week. I mean, the DAX, which was the hang on, got a sneeze coming on. Excuse me. I knew it was coming. The DAX was one of the best stories in 2025. Oh, this big rotation out of the U.S. Well, I said if the U.S. catches a cold, the world catches a flu, and the DAX was down 21%, and this mostly happened in 4 days of trading. So this is a complete reset for the year. Year to date, you're pretty much looking at Europe has been, smashed back to essentially break even. So this is what the year looks like so far. Now, I understand there could be opportunities to still be long Europe, but wow, like really volatile, and I'm less excited about that rotation. I'm still in. I still have some exposure. I'm long FEZ, but I'm just selling premium, and my premium's down to like the low 40s, so I'm okay. Let me see what I have here in FEZ. FEZ is selling puts at 49, 48, 47. So it's down a little bit, but with also that was adjusting for a 20% correction, and we had it. Like this is, let me go to FEZ. We came down to $48. We're back up to 49. If the DAX recovers, then this gets back above, and there's money on those puts. So anyway, like I said, it's just everything changed so quickly that Europe was pretty much squashed back to break even. The FTSE, I mean, man, this just nasty spill from high to low. FTSE was down, 15.5%, and most of that happened in about 3 trading days. And structurally, I would say that I like this stock way less. Like I like this the UK 100 way less than what I did when it was sitting up above the 200 moving average and it was above this trend line. Now that we're below this trend line, to me, this is a potential, like this is a halt. If at best this is a halt, meaning if we go high to low and we just spend some time kind of grinding back here, we could pull back to equilibrium, but those bears might drag this thing lower if we have another. If the U.S. stock market starts to go lower, FTSE's probably going with it. DAX and Euro stocks going with it. China possibly going with it. China just reset back to post-COVID lows anyway. So other than like Alibaba, everything else has kind of been reset. It's been pretty ugly. Okay, Argentina pulled back in that 200 moving average. I just need to do a little bit more digging on why do I want to trade Argentina? Well, I know country wise they've had some big reform and that's been helping. It's been one of the this is one of the better country ETFs last year. It was up a ridiculous amount. This is the 12-month. So last year Argentina, probably one of the best 2-year performances we've seen from any country. That was up 49% in 2023 and even better in 2024. Argentina was up 62% in 2024. So it got my attention, but I realized that okay, I was going to be patient waiting for a pullback. Well, I got my pullback. But is this good enough, or is this going to be just one of the many emerging markets that if the U.S. isn't doing well, nobody is. And that's the big fight. And I think all this stuff with China, U.S., April 9th, April 10th, which is tomorrow and Thursday. It's going to be interesting how that news kind of hits the markets as well. Are we gonna claw down and have another fit because it's more tariff uncertainty? Maybe. We obviously put in the low at 20+% between the S&P and the Nasdaq. So if there's more of a tantrum swing, then we could see another claw to the downside. Here's China. So what was looking good for that big rip in September pulled back to some nice fib levels, hit some higher highs. What it do? It gave most of it back. So in the bigger picture, I mean, technically it still looks okay. It looks healthy. I mean, we have lows here and higher lows here. But what's a key level for China? Probably finding some bottoming patterns around this I'd say between current prices around 19.9 down to 19,000. If this bottoms out and starts to head higher, that's fine. I don't think China's going to do that without the US. I mean, if we're going to play tit for tat with China, this probably drops and the US probably goes with it. Does one lead the other? Or they're both going to suck. And we're talking, deeper and deeper pullbacks, and the threat of recession and just the markets being down so much. All that's a legitimate threat. Brazil, I was excited about this thing getting above the 200 moving average. It's not, so I'll wait. I'm still long on EWZ and ILF. That's Latin America, but we're a long ways away. This is an emerging market that, again, probably needs to see some resiliency in the U.S. to get better. Mags was down, I think, over 30% from high to low. 33.5% from high to low. So yesterday was a pretty encouraging sign. I posted this in my Telegram. Yesterday, what is it? Maybe I posted the heat map yesterday. There it is. So I posted the S&P above the 50-day moving average. That was at some fresh lows, the 9%. So I'm taking some bites on the market right now. But Mag 7 was encouraging. You had Nvidia, Amazon, Meta, Google up yesterday. Apple was down, Tesla was down, and Microsoft was down. But because the S&P is so beat up and Nasdaq is so beat up with those, I mean, this is like, let me show you this level. So we talked about that market breadth indicator, right? Only 7% of all S&P stocks are above the 50-day. That's not very many. Okay, on the Nasdaq, even less. 5% of all stocks in the Nasdaq above the 50-day. Short term, I think that offers a relief rally, just because everything is so beat up. No guarantees, obviously, but I'd say within the next like 30 to 60 days. And maybe what we have to get through here, and this is what I talked about, like maybe this like cycle of March expiration to April expiration, which is the 17th, so not this Friday, but next Friday. Maybe that's enough to say, okay, we survived the cycle. It's a good opportunity to get long the next cycle because these symbols line up, right? This is so beat up. We're sentiment probably at crazy yearly lows again. So everyone's bearish. Put ratios are crazy high, and the market's sitting here with only about 5% of Nasdaq stocks above their 50-day. It's like everything is beat up. So if you want to buy value, everything's on sale, and it's not a long-term play. I mean, if we get a rally of 3-5%, great. We pull back into some of the technicals that the market created so inefficiently on the way down, great. But I think this is a good short-term indicator for maybe a April 17 to May 16 cycle. So just throwing it out there, like I think this market could be at least having some type of relief rally, but we probably have to get through the pain of the 9th and 10th, which is this week, get through CPI data, PPI data, which is Thursday, Friday as well. And then also on the weekly end on the 17th, that's the big monthly expiration for April. Okay. Anything else? Costco, super choppy. I'd like to see if Costco can come back down to something like this: high, low, lower, high, lower, low. Maybe start taking some bites on Costco. I'd love to see like a split lining up here. I love Costco as a stock. I've had it since I've been a member of Costco for a long time, but I'm not excited about trading options on a $900 stock. So it's just not as fun. Certainly nothing I would say like some of the trades I like to put on where I can collect some premium, not really want to own the stock, but if I did have to own the stock, I can afford to. With this price, I'm like, I'm not going to allocate that much money, for basically a $900 stock. No thanks. Even for a portfolio margin account that's going to tie up like $20,000 to $30,000, and that's just way too big of a chunk. So anyway, if it pulls back, great. If we get a split on Tesla, even better. Otherwise, I'm probably just out of this one for a little bit. I still have Walmart. I'm still trading this one defensively, even though it's been treated like a overvalued retailer. But I still like it. I mean, longer term, I think we still have Walmart in the hundreds. I've got a call trade in. If it dips lower, I'll watch that. Walmart's forward guidance on consumers. SPX, what the hell just happened there? Just had a trade fill for something. Oh, I got you. Okay, got another broken wing butterfly at the 5,000 handle today. Okay, so I have 50 cents, 65 cents, and 90 cents still running on the day. Hopefully, price will stay above the 50.45. Yeah, I want to see price stay above 50.45 today. Put a line in the sand here. 50.45. Be generous, please. Horizontal ray 50.45 is right in here. Okay, so I'm going to keep an eye on that level. Hopefully, we're not. I mean, if I understand if we're coming down to try to fill this gap today, but it's not going to be good because that is this market can't get to this gap, but we're going to quickly come in and fill this gap. Like I said, hopefully the volatility, like the VIX dropping today, will hopefully prevent some of these big intraday swings. And so even a move that's, oh wow, this dropped 100 plus points. Well, that's fine versus 800 points or whatever the hell the swing was yesterday, 400 some points. Yeah, 413 points yesterday was a monster move. So so far from high to low, we've already had about a 97-point move. On average, if this thing goes back to even a remotely average move, we're looking at about 140 points a day. So that should keep me clear of. I mean, this market have to drop over 200 points for me to be threatened on my positions today. Certainly can happen, but hopefully not. All right, starting to see some market maker levels fill back in around 5150, 5125. Hopefully, we're not going too much lower than 5100. Okay, Walmart, Nike. Sold some puts on Nike. This is actually this is like a leap. I mean, I sold a 50, 55.50, and 47.50 out to the end of the year. I know that China, Nike, you're going to have some issues. Retailers, if people are cutting back and stopping their sneakerhead purchases, then yeah, I mean Nike could be a lower, but this is lower than the 2020 COVID low, which I thought that was pretty disruptive to the supply chains. But I guess a trade war is equally as bad, um, and could get worse, but could also get better. Like the trade war situation, it's so much uncertainty priced in. It came out worse than what the market expected. And now it's just a matter of if US digs its heels in and China digs its heels in. I mean, you've got the immovable object versus the unstoppable force, right? And that's what's going on. So that's not a fun fight. Like you're talking, I mean, if anybody's ever read Ray Dalio or heard anything about the change in world order, like that's what's happening right now. It is literally a fight for number one. The U.S. has been king of the mountain for a long time. It's trying to stay there. China's been playing the long game, which is one thing. That's like the only thing I would say I respect about China is you have absolute power, and if you want to get something done, you can put it in place for the next 10 years and do it every single year, every single year, every single year until it's complete. The US, you have a complete flip flop every 2 to 4 years. If everyone's pissed at Donald Trump and this administration, in 2 years, they're going to show it by flipping the elections. And all of a sudden, the House and Senate will be given back to Democrats. And you're going to have a lame duck presidency for the next 2 years after midterms, right? Like I think that's a big problem in the US is one side says, this is what we're going to do. We're going to take away everything the previous administration did and do our thing. And then if they lose and the pendulum swings the other way, that administration was the worst thing ever. Terrible things for the economy and in the world, blah, blah, blah. It's just constant back and forth. It's the circus. Okay. Anyway, anything else? Amex watching, MasterCard Visa watching. Some of these trades I've got some exposure in. Uber's fine. Sectors. Let's look at year-to-date sector performance, and I'll go into some currencies and I'll let you go. So here's year-to-date. Not looking good. So where's the best place to hide out this year? And this is what I said. This could be like the sectors of sucking less, right? Consumer staples, good place to hide out. Not a bad sector to hide out. Healthcare, great sector to hide out. Okay. Real estate, utilities, yes. If you're looking for safety and low beta and a non-correlation this year, staples, healthcare, and utilities. The problem is they're still red for the year. So that's not super encouraging. But I mean, consumer discretionary at some point will be a great bargain. but it's down 18.5%. Technology, always the more volatile sector, down 20+%. Nasdaq year to date down nearly 14%. And 20+% peak to trough so far. But if you're looking to hide out, utilities often pay good dividends. Healthcare has some growth opportunities. Is also a little bit of an AI play. Some of the most common job as we're getting every month is coming in the healthcare sector. We are a service and tech based economy. Healthcare is going to be this huge boom of like baby boomers retiring, one of the wealthiest generations ever, and needing that extra healthcare, needing workers to fill those roles. And so, I mean, again, you can just see performance wise, these have been the most resilient sectors so far, and probably are a good place to hide out if you're looking for, I still want to be invested, but I want to have less volatility. Well, there's a good place to be stable. Consumer staples, most of these are also low beta, and some are dividend plays. Utilities, most of them are low beta and dividend plays. So anywhere between, I'd say like a 3 to 5% dividend is pretty respectable. Staples maybe in like the 2 to 5% range as well. So I mean, a dividend portfolio is not all it's cracked up to be. You pay taxes on dividends, so everyone thinks it's free money, but you're paying taxes on it. Um, so it's kind of a wash. But it also, it feels better to have your money feel like it's moving uh, less to the downside. Mark's down 20% and your portfolio is down, 3%. That's cool. The 60-40 portfolio is behaving okay, but bonds are not doing you any favors right now, right? So just a lot of stuff to juggle. I'll say this: look, if you don't want to trade any of this kind of sector rotation, you just want to trade the index, trade gold, trade futures, trade forex. It's fine. Risk management is going to be the only thing that saves you, right? A year like this, everyone that's watching the stream, if you survive this year, it gets easier from here. Like, is it possible that the market drops 30% from peak to trough, 35%, 40% peak to trough? Yeah, it's very possible. In this day and age of like everything is super extreme and super fast, I wouldn't be surprised if we somehow find the all-time highest VIX ever. We somehow have like the most historic collapse in the market ever. Like, I thought 2008 was bad at 56%. Maybe that's nothing. Maybe that's revisited for no reason other than markets just move faster and it was like an overreaction, but we had a 50+% correction in the market, you know. But if you can survive that, then getting back to those all-time highs is a monster gainer. And if we get back in 2, 3, 4 years, you're doubling your money. So whatever you have invested, if you can survive it, you can do pretty darn well, you know. But that is going to be the biggest key. It's like, I'm not in a position right now to be wanting to take lots and lots of high risk trades. I don't mind taking more trades. I mean, I've deployed probably $300,000+ in capital these last 2-3 weeks as the market has been dropping and volatility has been way higher. I've been selling premium because it's been at such a high level that I can go way out of the money, way past the expected moves, and hopefully see some good mechanical trades. But that doesn't mean anything. Like, it looks good on paper, it's theoretical. But if the market is going to do outlier type moves, I'm still risking trades. And to put it in perspective, 1987 was a 20 standard deviation move. 20, right? This market loses its mind when we have like a 2 to 3 standard deviation move. Oh, did you see that earnings report? It was like a 3 times standard. 20, and that was to the downside. So it can happen. Like, black swans and outliers can happen. Was this last couple weeks a black swan? Not really, right? I mean, I showed you how easy it was to forecast it. It was just a matter of, we just got there fast. I mean, the fact that we got to the technical measurement in 3 days is what rattled this market, right? If it was like, well, we're just, once we broke the lows, God, I just, if I keep talking like this, I feel like my voice is going to sound like RFK Jr. I don't know. This year, my voice has been like half gone half the time. Anyway, but getting this move here, hanging out around that 200 moving average, a slower grind to the downside would not have been a huge surprise. It wouldn't have been. But the fact that this was measured and broke the lows and just went right to the measured move in 3 days is insane. And that's why everything got so exaggerated so quickly. But now that the market does that, let's say this is your tuning fork. There's your high low. Well, now the market's probably going to do something like this. right? And we figure out how this all settles in. If the low is safe, we'll figure it out. It's going to get uglier and harder if every time this market is like, hey, up on the day, and then it gaps lower and just tries to revisit lows again, and then up on the day and then flushes, and up on the day and flushes. Just don't be surprised to have some days that just make your head spin. There will be good opportunities, but remember, trade small, control your risk, and think big picture. Like, think about, I've got to be in this market for the next 12 months. I've got to be in this market for the next 2, 3, 5 years. If you think with that survival mentality, you will be fine. And I know that may not paint the big picture of how much money you want to make this year, but if you don't survive this year, you're not trading anymore, right? If your risk capital is gone and you have to reset and start over, that's going to take away all of the excitement and hope and all this good stuff about trading. It's gone when you blow up your account. So surviving is the name of the game, and trading small in these environments where we have these wacky, crazy intraday moves, it's annoying to like, well, I'm not making what I want, right? But if you're not understanding how to safely make money in these environments, how to play defense, and how to be nimble and agile with your portfolio, look, the market doesn't have anywhere safe to be. If everything is down systemically, you're screwed. Unless you are short, unless you are hedged, that's a different play. But to be a bear, I mean, talk to anybody over the last 25 years and say, if you're a perma bear, how much money have you made? Because if all you did was make money during 2000, 2001, or make money in 2008, or make money in 20, maybe 15, 16, maybe 2020, I mean, you're getting like one big payday over every 4 to 6 years. That's not sustainable. I mean, I would, and plus the timing of this is so difficult. And all we've seen for the last 15 years is like buy the dip, buy the dip, buy the dip. So point is, bears jump out of windows, and it's difficult to time. It changes everything. Liquidity goes out the window as well, and it's just extremely disruptive, and it's also very irrational. So survival is the best thing. And to survive, you got to trade small. Nothing should be big or guaranteed. I mean, look, I literally don't take any risk higher than probably 1 to 2% on a maximum size. Most of my trades are less than 1%. Every trade I take, risk defined, probably a quarter to 1%. Like quarter 1%, half 1%. 1% is like a pretty big chunk, just because I'm like, I got to like the trade to take a 1% risk, because then I'm just going to trade thousands of times. And that helps. And the same thing was even in currencies. When I traded currencies, I didn't have stop losses when I trade currencies, but I trade so small and so boring that it gave me plenty of time to just manage my trades. I mean, I'm in drawdowns right now. Like, I've got 6-figure accounts that are in like, 8% drawdowns. Okay. But 8% is manageable considering the world just went to the brink of like a, systemic collapse for, 3 days. So we'll see how. I mean, I hope they all come back, and I trust the technicals of the currency market to be efficient. But it's been very disruptive to make like fresh historic lows again on some of the pairs that I'm trading. So the nice thing is there's inefficiencies with that, and I think we'll build back into those. But I trade very, very small to survive that type of calamity, and then I can always add to my winning trades. I just want to see more confirmation. Same thing is true when I'm trading options. It's risk defined. If I really like a trade, then yeah, I'll add more trades to it. I'll add to my core position. If I like a trade, I'll have some stock in it. I'll trade a lot of options for income. I'll lower my cost basis. It's like I'd rather take lots and lots of little bites to build up my trade into the investment that I want, as opposed to I'm all in. This is it. There's my 2%, give or take. Like, it's great when you're right, but it sucks when you're wrong, especially like this when there's nothing good happening. That 2% risk, even though that seems manageable, 2% risk on 10 trades, there's your drawdown for the year. And you're toast, right? And 2%, like, most traders aren't that small. Most traders trade, 3, 4, 5, 10%. Most traders have no idea how to manage risk, and they blow up. So anyway, I don't need to preach. You get it. If you're still here and trading and surviving, good. Hopefully you're doing it by doing the right things. If you're a little stressed, I understand. You can see why. This has been probably one of the more difficult environments that I've traded in 25 years. But it also wasn't super surprising to see it. It's just there's not much you can do when the market goes from crazy low volatility to high volatility, and does so in 3 to 4 days, which is like, it's one of the wilder moves I've seen since COVID. But if you can survive it, there's plenty of opportunities to be profitable. The bulls will offer you what seems to be an infinite amount of opportunities. The bears will offer you short-term opportunities, but they will offer you all of the lessons to teach you how to protect your portfolio. Because in an event like this, when it's not just a fall and buy the dip and it drops and gets worse, that's usually what scares traders out. If you have a dip, well, that's easy. Well, yeah, I just bought the dip, as we've been conditioned to do for 20 years, But if it's a dip that becomes a third leg, becomes a fifth leg, that was 2022. That was 2008. COVID had like maybe a little three-wave move. It was so fast in 30 days, it was insane. But a drop, rally, drop, rally, drop. That's 2000. That's 2008. That's 2022. Those are legitimate bear markets that most traders struggle. So, like I said, just be careful. All right. Anyway, I'll let you go for today. I think. What the heck is this? I guess I got to go. I got a webinar in just a few minutes. Okay. I'll let you go for today. Thanks for being with us, and we'll be back at it tomorrow. Thanks.
Thanks for watching today's A1 Trading Show. Be sure to subscribe and to turn on notifications so you don't miss the next one. All month long, you can get the Edge Finder 40% off, our best discount of the year. Check out the links in the description below to visit the Edge Finder homepage, or speak with a team member directly to get the 40% off discount now. Trade safely, and we'll see you tomorrow.